Okay, welcome to the SLP1 for Finance 301, Principles of Finance. This is the Introduction to Financial Management and Financial Markets. For the SLP1, you're asked to just pick 3 stocks, make 3 purchases in your model portfolio. Now, there's a stock market game associated with this class. You might be doing that on MarketWatch. You might be doing that on investing.com. It's up to your instructor whether or not you're going to do that and whether it's going to be graded or not. So some instructors grade the stock market game, others make it optional. Others use different websites because sometimes the MarketWatch website has bugs, it has issues, so the instructor uses a different source. Sometimes the MarketWatch is working well, so we just use that. So it's up to your instructor, but regardless of how you do the stock market game, you're going to have to do this SLP where you pick 3 stocks and make 3 purchases here of 10,000 each. You don't have to use fancy methods to pick the stocks. You don't have to, get into high finance. You just have to pick actual publicly traded companies where there's data available on investing.com or Morningstar or Yahoo Finance, any of the numerous web pages, or even your brokerage service like TD Ameritrade. You can get information. So you might just like the company, you might be familiar with the project, you might have a relative or friend that works there, or you might work there yourself. So they want a lot of information about the companies that you pick. They want to know this ticker symbol, a description of the business, the reason you bought it, current share price, the close, previous close, 52-week high, 52-week low, market cap PE ratio, and whether it pays a dividend or not. So I'll show you how to. We're going to show you how to gather all that information. All right. So in the SLP1, I talked a bit about value versus growth stocks. Some of you, will have a preference in the stock that you pick, value versus growth. Now, the assignment doesn't really require you to do that. So you don't really have to review these slides on value versus growth if you don't have time. But I'm going to cover them just to give you a picture of how kind of the stock selection process works. So growth stocks might not pay a dividend. They might have a low PE. They might have no earnings. They generally have fast revenue growth and hopefully have fast earnings growth. Now in markets, there's historically been an inverse correlation between value and growth, especially right now. Right now in 2021, in the COVID era, there's a huge correlation between value, or inverse correlation between value and growth. And that's because a lot of your growth stocks like Amazon, Amazon's kind of a COVID-proof stock. So when COVID happened, Amazon actually did quite well coming out of it. When COVID first happened, Amazon went down and so did Walmart. So COVID caused both value and growth stocks to go down at the same time because COVID was a market shock. Any serious market shock like 1929 crash, the 1987 crash, the 2001 dot-com bubble bust, the financial crisis of 2007, 8, and 9, those types of events cause all stocks to go down at the same time because they throw the baby out with the bathwater. That's the expression. They just kind of, there's risk, so you want to sell all your stocks to avoid the risk. At least that's what some people that move money around in the markets think, right? And so everything, there's the correlation between value and growth gets very high. They actually have a positive correlation. They move up and down at the same time when there's market risk and market volatility. Now, when that market risk and volatility goes away and investors begin to piece together what's going on, which is what happened with COVID. Everything went down at once in March, February and March of 2020 when COVID happened. And then in the recovery, the value stocks recovered first. I'm sorry, the growth stocks recovered first, and that was because Amazon and some of these like the sports betting websites and the online casinos, the internet, various internet companies, internet businesses, they were perceived as not really being impacted by COVID that much because people wanted to do like DoorDash, people wanted to buy things from home, and do more things in the house. So these stocks did very, very well coming out of COVID. And the value stocks underperformed because if your value stock would be like Delta Airlines, I mean, they obviously, they didn't know when the country was going to reopen, and so they lagged the rest of the market. Now, when a vaccine was announced in November after the election of 2020, stocks like American Airlines and U.S. Steel and, banking stocks, your traditional value stocks, started to outperform the rest of the market. So COVID caused a direct correlation between value and growth stocks. They all went down at the same time. But then when they came back up, they had an inverse correlation. The growth stocks did better when there was bad news on COVID, and when there was good news on COVID recovery, the value stocks took over and they outperformed growth. So value to growth performance has been contingent upon the news about vaccines and reopening the economy and that kind of thing. Um, Now, there's more to the story of value versus growth. Uh, at other times, right? So value stocks do well when there's inflation. They do well when there's rising interest rates. They outperform in recessions because I've talked about it before in these slide presentations we do for the various SLPs and cases that there's that stocks are a certain stocks are bond proxies. What I mean by that is AT&T stock pays a 5% or higher dividend. So right now, so does Exxon. Well, if I'm a bond investor, right? One of the things we're going to learn about in this course is that when interest rates go up, bonds have to go down. Bonds have to sell off because I can get more interest income elsewhere. So the bonds I own today are no good to me because they don't pay as much interest. So I've got to sell them to buy either bonds that pay a higher rate, or I've got to go buy something to substitute for the bonds. And if the direction of interest rates is that it's going up all the time, if interest rates start to go up every year, what happens is people don't want to own bonds anymore because the bonds are going to go down in value every year because there's always going to be higher paying bonds the next year. So people are forced to sell their bonds. And if you're forced to sell your bonds, what are you going to do? Well, most most of the bonds in the country, in the United States and around the world, are owned by insurance companies and pension funds. Not all, but a good chunk. A good chunk of bonds are owned by insurance companies and pensions because insurance companies have to pay annuities out to people, right? And pensions have to pay, pension funds have to pay annuities out to government employees, things like that, private sector employees that get pensions. So they need to generate income every month so they can pay the checks out to all their pensioners every month, right? Or all their annuitants. So the way they do that is they invest in bonds because bonds pay you interest on a regular basis, every quarter, every year. And so you can take that interest income and use it to make your pension payments. So that is traditionally how things work. Now, when bonds get clobbered because interest rates are going up, that model has to change. And because the bonds become too risky for the insurance companies and banks and pension funds to own, so they have to sell them off. And what do they buy to replace it? Well, they buy a bond proxy. So they buy a stock that acts like a bond. And Facebook is not a stock that acts like a bond, right? Because it doesn't pay a dividend, it doesn't have any earnings, it's a growth stock. But value stocks like AT&T, like PSE&G, natural gas, utility company, like Exxon, they pay dividends every month and they kind of act like a bond. They pay dividends every quarter, they act like a bond. So, every 3 months you get a dividend and it's comparable to the return you'd get on a bond. So if I invest my bond money into these high dividend stocks, I'm going to get income every month that I can pay out my pensioners. So a lot of times what happens when interest rates go up is that, you know, more money goes into financial stocks, more money goes into value stocks because they pay regular dividends. And another thing is banks make money giving you a 30-year mortgage at a fixed interest rate. And then, the rate, basically the way a bank makes money is they pay you 0.1 interest on your checking account, and then they take that money that's in your checking account and they lend it out to people for a mortgage and they charge them 3% for a mortgage. So if interest rates go up, banks do very, very well because the spread between a 1-year savings account rate and a 30-year mortgage gets bigger and bigger and bigger the higher interest rates go. The higher interest rates go, the longer term rates tend to go up by more than the shorter term rates. That's called the yield spread or an interest rate spread. So the bigger those spreads go, the higher interest rates go, the bigger those spreads get, the more money banks and insurance companies make because they make money on the spread between interest rates. So they do well because of that, and they do well because their stocks are kind of like substitutes for bonds for some investors. So when interest rates are going up, value stocks tend to outperform growth because of, because a lot of value stocks are kind of like bond substitutes or bond proxies, as I like to call them. And growth stocks do well in a strong economy where there's low interest rates. So if interest rates are going down, if they're low, growth stocks can do very well because they're not really a good bond substitute. So if interest rates are going down, that means bonds are in a bull market. Bonds are going up in value uh, because the bonds of the future are going to pay less interest than the bonds of today. So people want to own bonds, and if that's the case, then growth stocks are going to do well because they're considered to be more of a maturity type investment. So a growth stock is a good investment over a very long period of time when the business has time to mature. A value stock is a very good investment in the near term because they have earnings in the near term to support their value. So as interest rates go down, the value of things in the future, or the present value of things in the future, goes up, and as interest rates go up, the value of things in the present is more than what the value of things in the future is. And so interest rates determine whether growth stocks or value stocks will do well or not. And as you see in this course, as we learn about present value and some of the other um, uh, lessons, and as we work our way through the course, you kind of get to see how that all works. So that's basically a high-level overview of value versus growth. Now, to Warren Buffett and his Columbia Business School professors Graham and Dodd, value stocks had to be valued more as a going concern, as a business enterprise based on the financial statements, than as what the stock market valued them at. So they actually took stock and valued it as a business using business valuation methods, using like accounting and finance methods for valuing a business as a series of discounted cash flows, kind of like the way we were learning in this class how to value a bond. That's how they valued whole companies. And they would look and see, well, if the company is trading at less than what the value per share of our model says it is, then it's undervalued, we should buy it. And if it's trading for more than that, it's overvalued, we should sell it. And they looked at the competitive factors of a business to ascertain value. So one of Buffett's criteria and one of his professors' criteria that they taught him was that a value stock had to have a wide competitive moat. So they've got a brand position like Coca-Cola. Like Coca-Cola, if I start a soda company tomorrow called Bob's Soda, it's not Coca-Cola. It doesn't have they don't sell it. They don't have a commercials at the Olympics for Bob's Soda. They have it for Coca-Cola. So Coca-Cola has this brand that's associated with America and nostalgia and different things. Means different things to different people, but it has a brand that's very powerful, and that brand prevents other soda companies from coming in and grabbing market share. So that's the kind of thing that value investors look at. Examples of strong brands would be Coca-Cola, See's Candies, and other iconic brands that Warren Buffett invested in. So looking deeper at value investing and competitive strategy, there's a professor at Harvard Business School called Arnold Porter, and he had Porter's 5 factors of um, competitive advantage, of competitive strategy, and you can read more about that. If you can look into that if you want to. He is one of the great masters of business competition and business strategy. But Buffett did not believe that Alcoa, for example, was a value stock. So Alcoa, ticker symbol AA, is a big company that makes aluminum for like tin cans and things like that. They make aluminum for aluminum cans, aluminum siding. Aluminum is a commodity. So Buffett's thinking was, well, Alcoa can't be a value stock because anybody can mine the ore that they used to make aluminum. It's called bauxite. They turn it into alumina, and then they turn that into aluminum. Alcoa's aluminum wasn't worth more than Rio Tinto's or any other competitors. It was just aluminum. It's like we just make peanut butter here. It's not Jiffy peanut butter. It's just peanut butter, right? We just make the peanuts. So therefore, they don't have a competitive mode because they just make a commodity. So he saw like a banana company or an orange company or a timber company or because one company's timber isn't worth more than another's generally. So there's no real competitive advantage. And he saw the same thing in like materials companies like US Steel and Alcoa. He would never call them value stocks, but they are nonetheless in the Russell 1000 Value Index because they meet all the quantitative criteria of a value stock. So not everybody agrees on what value stocks even are. But some people say they have to have a competitive moat, they have to have certain criteria. Others just say, well, if it has a low price to book ratio, a low PE ratio, if it's in a more traditional sector of the economy, it's not in a high growth sector, then it's not a high growth company. It doesn't have high earnings growth, but it has, low price earnings ratios and it's as a safe valuation, then it's going to be considered to be a value stock. So, top down investing looks broadly at these different criteria that I just mentioned to figure out what's a growth stock or a value stock. Top-down investing is about looking at the market from the top down, looking at all the ratios and indicators with the stock and saying which basket does it fall in. So we're sorting from the universe of stocks down. Bottom-up investing is what Warren Buffett did. He looked at the accounting of the business, valued the business as a going concern, based on its accounting records, and then on its business strategy and its operations and his estimates of what the future prospects of the business were, and then he selected stocks based on that. So he would analyze 100 stocks and pick one or two, whereas top down is looking at the universe of stocks and working your way down. So Buffett was a bottom-up investor. Stanley Druckenmiller from Pittsburgh, Pennsylvania, he's a good example of a top-down investor. He's more of a guy who looks top-down and not bottom-up. So there's different people that have different perspectives on these things, and you know, some of them, they've all been successful. Different people from different perspectives have all been successful in different ways in the market. All right, so the power of index investing. Indexing is top down. It looks at the universe of stocks and then filters down based upon statistical characteristics such as liquidity, value, growth, market cap sector. This produces a great sample size over time and with less effort, right? So Buffett can at most pick 20 stocks. It's just too much work to pick 100 of them because you got to do that big accounting analysis on every company. And top-down investing, you don't have to worry about that. It's a real quick decision. It's statistical sampling. So it's significantly less effort and cost in doing indexing or top-down investing. And it has less non-systematic risk because, systematic risk is the risk that's inherent in a company. Nike might be mismanaged, might have a lawsuit, they might go bankrupt next year. Probably won't happen, but it might happen. So the systematic risk is if you put your whole portfolio in Nike, it might go under. But if you put your whole portfolio in 10 stocks, probably 9 of them will still be here in 10 years. One of them might go under. If you put your portfolio in 30 stocks, you've even got a better survival rate. But the S&P 500 is 500 stocks. So there, 1 or 2 of them will go bankrupt for sure in 10 years. But, the other 498 will be fine. And so your money's safe, relatively speaking. And so there's less non-systematic risk, less company-specific risk when you buy 500 things instead of 1 or 2. So that's the advantage of indexing. The indexes also are managed by, like Dun & Bradstreet, Standard & Poor's. They're managed by statistical firms that look at the market cap of each company and weight it in the index. And so if companies are doing well, their market cap's growing, they buy more. If companies are doing poorly, they cut the loss and buy less. And so that is an important concept. The idea of averaging up on winners and not averaging down on losers, because people, as humans, don't like to admit that they're wrong. That's a basic psychological tendency of human beings. And so because people don't like to admit that they're wrong, they tend to average down on losers and sell winners too quick. And that's called prospect theory. The theory behind why people do that won the Nobel Prize. Daniel Kahneman and Amos Tversky, those were the 2 guys who got the Nobel Prize for that. And basically they said that people tend to they walked around a college campus and they walk around the campus of Trident University and they asked, this is what they got the Nobel Prize for. They asked students, it wasn't a Trident, but same concept. They walked around a university and asked students questions. Would you prefer a 50-50 chance at 2 vacations to Switzerland that are 5 days each, or would you prefer a 100% chance at 1 vacation to Switzerland, right? So, and everybody took the 1 vacation to Switzerland, even though statistically a 50-50 shot at 2 things has a probabilistic weight of 1. So it's worth 1 vacation, but nobody picked, very few people picked the second option. Almost everybody picked the first because people prefer certainty over uncertainty. And so, and people avoid, they value avoiding losses more than they value at making money. So, because if people are naturally risk averse, you got to think around humans living around, prehistoric times with saber-toothed tigers. You didn't think in terms of, I'm going to take more risk because, you might get eaten by a tiger, right? So, I mean, this is going back to primordial times. People naturally would rather avoid a risk versus taking it, even if the objective mathematics, the probability theory says that the risk has the same value. A riskier situation with a higher payoff has the same value of as a less risky situation with a lower payoff. And so markets tend to overprice low risk versus high risk, high reward situations. And that's why people do discretionary money management, because they see that as an opportunity. So, but the problem people have is they want to double down on their losers because they want to avoid risk, and I think if they're losing money on a stock and they buy more of it, then they will be able to wipe out their loss, right? Eventually when it bounces back. And a lot of times what happens is a losing prospect is a losing prospect for a reason. And that's why the statistical indexing takes care of all that for you. They cut the losers and add to the winners. And that's why they tend to beat a lot of humans over time, because the statistics is more objective than the human brain. The human brain is subject to, how much coffee you had this morning, what kind of mood you're in, and a lot of other things. So it's hard for a human to beat a statistical model for that reason. Um, so anyway, that's just a preview of some behavioral finance, which is an important aspect of investing. All right, so getting down to the brass tacks here, so to speak, how do I get this information I need on my stocks? Bottom line, to do this assignment. And so, you know, punch in a ticker, right? And you don't know the ticker, type in the name of the company. I typed in Berkshire Hathaway. I typed in the first four letters, Berk, right? And it comes up, BRKB is the B shares of Berkshire Hathaway. Now, Berkshire is a weird company because it has A shares and B shares. That's because they've never split the stock. So I think an A share costs like $200,000 a share or something. So I just picked the B share. Now, most stocks will just have one ticker, but Berkshire has two. It doesn't matter which one you pick, just pick a ticker, pick a stock. So I'm going to type in Berk for Berkshire Hathaway in Yahoo Finance, and I come up with BRKB. And this is finance.yahoo.com. That's the website I went to. You can go to any website you want to. You don't have to go by this, but Yahoo's a great website. What happens when I type that in? Let's go to the next slide. So when I type in BRKB, when I click that from the pull-down menu on finance.yahoo.com, I get the share price, I get the open, the previous close, and this is my summary screen. If I just read down the screen, I get the 52-week range, the days range, the volume. In the second column, I get the market cap, I get the beta, I get the P ratio. They don't have one. They must be operating at a loss or something, which is weird. Earnings per share. Um, Earnings date, and they should have the dividend yield on here somewhere. Yeah, I guess Berkshire isn't paying a dividend, but if it did pay a dividend, it would show it here on this first page, forward dividend and yield. Now, that's the summary screen, right? So when you pull it first up, this is what comes up, summary. Now, if I go over here to where I highlighted in yellow statistics and click on that, it'll show me the price to book ratio, other financial ratios. If I click on profile, it'll give me a summary of the business. So one of the things for this assignment is you need to give a history or profile of the business. The profile screen will give you that. And then the financial statements are the fourth thing. You really don't need that, but if you want to see the income statement or the balance sheet, you can see the accounting statements of Berkshire there. So you just type in the name of a company, any company you think of, in the pull down menu on Yahoo, you pick the company, you select it from the pull down, and then you go to the screen and you get all the information you need to do the assignment. You can also use Market Watch, you can use TD Ameritrade, Thinkorswim if you have an account there, or if you set up a paper money account. So there's a lot of different places you can get this. Google Finance. So this is how you get the information to do the case one.